gone.
Alright, today is Wednesday, March 3rd, and this is a post-market review for the stock market activities today. On Monday, we witnessed a huge rally across all indices, specifically for the high multiple names in the technology sector. We know that these names got whacked significantly during last week's sell-off due to the fears of inflation. On Monday's video, I floated the idea perhaps what we're seeing in the market's rally, specifically for these high multiple names, is perhaps a fake rally, a dead cat bounce. And the reason is we did not see any change regarding the inflationary fears or any significant retreat in treasury yields. Yesterday, we saw a give back, specifically in the Nasdaq, and today we saw a massive flush down, and we have erased all of the gains from Monday's session. The inflationary fears did not go anywhere. Matter of fact, every single data we received this week added to the inflationary fears. And the Federal Reserve continues in their tour of propaganda, manipulation, distortion, instead of actually addressing the problem. They wanted inflation all along. Last year, they have been on a propaganda tour trying to play the psychological game to increase inflation expectations. Well, you got what you wanted. Inflation expectations are rising higher, and therefore yields are climbing higher as well. So what are you pissed off about? The Federal Reserve is pissed off about the fact that the market is selling off due to the rise in treasury yields. They want their cake and they want to eat it too. They unleashed the genie out of the bottle, that is inflation, and now they want to put it back because it had the impact they intended for a little sooner and faster than they expected. So what now? Because the propaganda tour is clearly not working. The Federal Reserve will have to resort to its toolbox. We talked about the manipulation that is going on in the US dollar to push commodity prices lower. That is going on behind the scenes right now, but it is not tampering down inflation expectations at all. In addition, the pump we witnessed on Monday's session due to the coordination between the Federal Reserve and the Bank of Australia to increase their bond purchasing program is already fading away. So what is left here for the Federal Reserve to do? The rational answer is you do nothing. This is what you asked for. Inflation is rising higher. You will push GDP higher and it will push economic activities higher. We have a new stimulus on the horizon that will increase consumer spending. The economy will recover and some employment in the food services, leisure, and retail sectors will also recover. This is exactly what the Federal Reserve wanted. But because we're seeing a sell-off in the stock market, the Federal Reserve all of a sudden has to resort back to its original mandate. They've enacted the policy of increasing inflation to serve their public mandate. The public mandate is to achieve full employment. But the secret mandate for the Federal Reserve is to protect, preserve, prop up, and inflate the assets of the wealthy, stocks and real estate. And you have this conflict going on internally in the Fed between the public mandate versus the secret mandate, which is their main mandate, by the way. Tomorrow, we will hear from Federal Reserve Chairman Jerome Powell, and he has to do something here to calm down the market. And my guess is, since propping up the US dollar is not working so far, the propaganda is not working so far, the scummy coordination with the Bank of Australia did not work out. So the Federal Reserve has to make a decision on its own tomorrow. Jerome has to make a decision. Either he is going to announce that the Federal Reserve will increase its bond purchasing program or extending the maturities. That is another option. Yield curve control is out of the table right now because it is an extreme measure. And if it's taken, it will signal to the market that the Federal Reserve is actually fearful of inflation and they are hiding the true picture of inflation. So yield curve control is not on the table right now. But here is another option. Operation twist. What is Operation Twist? We know that the Federal Reserve is buying a ton of bonds. They need not to increase their bond purchasing program. What they can do is shift the bond purchasing from the shorter end of the yield curve to the longer end of the yield curve to bring down the yields of the 10-year and beyond. That is a temporary distortion tool from the Federal Reserve to calm down the market. Will it work or not? That is the big question. We know in the long term that this is not a solution, but will it in the short term calm down the market and encourage market participants to buy the dip? We will try to answer this question throughout our coverage because we will talk about this subject and a lot more during the headlines of the day segment, and we will revisit the issue during the conclusion of this video. But for now, we got a market to cover, and here we go. The Dow Industrial Average closing in the red, down by 121.43 points, or a decline of 0.39%. The Nasdaq leading the declines, down by 361.4 points, or a decline of 2.7%. The S&P 500 in the red, down by 50.57 points, or a decline of 1.31%. And what about the sector's performance for today? Leading the pack and capturing the gold, silver, and bronze. Energy, the only section of the market closing in the green today. Financials closing in the green by just a tiny bit, but all in all, pathetic performance across the board in the market. The laggards of the day led by technology, communication services, and consumer cyclicals. Moving on to the futures market performance, what do we see here? Crude oil rebounding higher once again, adding to the inflationary fears. We're now closing at the 65 level for the Brent. And of course, we know about the upcoming OPEC meeting and how that would impact the prices of crude. They are interested in pushing it higher because we know that the price of 70, 75 is the ideal price for most producers. But they also want to take advantage of the current prices by increasing their supply, yet without pushing prices down too much where the 70 to 75 outlook becomes unattainable. So once again, just like the Federal Reserve, OPEC wants its cake and eat it too. But regardless, the inflationary fears are pushing oil prices higher. We are still in lockdown mode for the most part globally. So where is the demand on oil to support these prices? It is not there. But what's there is inflationary expectations due to all of the cocaine printed out of thin air from central banks across the board and spread all over the place. Traders and market participants are expecting that all of this cash, the money supply, will result in an explosion of spending and economic activity, which will push crude prices higher. So they're buying first and they're asking questions later. Regardless, the push higher for crude oil prices will increase inflation expectations, thus pushing yields higher in treasuries. What about softs? We saw declines across the board, led by cotton, sugar, OJ, and coffee. Meanwhile, we saw modest declines for lumber futures and a muted session for coca. What about metals? Pain across the board? Once again, the manipulation attempts of pushing the US dollar higher by the Federal Reserve is showing up in lower commodity prices. Just a touch, not enough to remove inflationary fears. And that is evident in the action in the futures market today, specifically in metal prices. Gold down, silver down, platinum down, copper down, palladium down. And when we shift to grains, we also saw declines here for corn, wheat, canola, soybean meal futures, all closing in the red, while we saw modest gains here for soybean oil and rough rice futures. What about meats? We have sizable gains here for meats due to the shortage of supply, specifically for lean hogs. We saw massive gains today for lean hogs futures, and here is an explanation. Hog prices are surging in the US amid an outbreak of African swine fever in China. And right away, you saw lean hogs futures scoring over 3% gains today. Moving on to the options market, the big casino. Let's see what's going on here. One cannot help but to notice the decline in volume across all activities in the options market. And that reflects a very important message, that the majority of retail traders got caught with their pants down. They were already all in, either positioned in certain stocks or they've already bought their call options in the sudden rout in the market with treasury yields rising higher and momentum and growth stocks, which happens to be the retail crowd's favorite names, went down significantly. It tells me that the retail trader got caught with their pants down and they have no more money to deploy in buying and trading options. Therefore, we're seeing subdued activities across the board, even for the biggest names such as Apple. And the question here is, will the stimmy money revive the action and the volume in the stock market? Will the stimmy money be a much needed ammo to fire back from wounded retail traders and investors? That is the question. The problem is, we have another wrench thrown regarding the whole stimmy situation. We'll talk about that in a little bit during the headlines of the day's segment. But back to the casino. At number 1, Apple, with a little over 770,000 contracts. About 66% of those were calls. And at number 2, AMC, with about 400,000 contracts. About 32% of those were calls. So the majority of the bets are now to the downside. And we're seeing significant uptick in put options buying across the board. NEO at number 3, with about 370,000 contracts, about 63% of those were calls. Notable activities for Boeing as well, with about 300,000 contracts, about 81% of those were calls. So once again, bearish bets against the high growth names, meanwhile bullish bets for the so-called cyclical and comeback stocks, reopening, whatever you want to call them. And it is also interesting that we saw GameStop gaining about 5% today. Meanwhile, the majority of the bets were against GameStop. We saw about 250,000 contracts traded today for GameStop, but 84% of those were actually puts. Very interesting here for GameStop. Speaking of interesting, what about the interesting unusual trades that took place in the options market today? How about we start with the ticker XOM? This is for ExxonMobil. We saw massive gains here for the energy sector, specifically for ExxonMobil. And somebody's bidding on further gains here by buying the 60 calls, expiration date April 1st, with expectation that ExxonMobil will gain over 5.5% by then. And they paid about $1.20 a piece to enter this trade, bringing the total to about $2.8 million. Here's an interesting one for the ticker LVS. And I did issue a tweet yesterday implying that I am buying LVS calls. And I covered LVS chart yesterday, showing you all the technical indicators, showing bullishness and an imminent breakout for the name. It seems that the market agrees with me because we saw significant uptick in options volume for LVS, specifically call options. So either the market is listening to the Maverick Wall Street, or there's actually news for Las Vegas Sands, which we will cover during the headlines of the day's segment. It's tough to figure out which was the motivation for options traders to bet on Las Vegas Sands. I'd go with they're following the Maverick Wall Street, just to feed my ego. Anyways, here is the bullish trade for LVS. Buying the 72.5 calls, expiration date May 21st, with expectations that the name will gain over 10% by then. They paid about $3.30 a piece to enter this trade, bringing the total to about $5.5 million. What about the ticker AA? This is for Alcoa. Alcoa is up over 50% in less than a month. We've been seeing this shift towards cyclicals, energy, materials, starting last year actually. It's not a new phenomenon. Alcoa has been gaining since last year, so if you did not get the message back then, you're probably getting the message right now. Anyhow, somebody's making a bullish bet here for Alcoa, betting on more gains to come by buying the 35 calls, expiration date April 16th, with expectation that Alcoa will gain over 13% by then. They paid about $1.50 to enter this trade, which brought the total to about $1.5 million. Here's another interesting trade for the ticker NIU, and this is for a Chinese company that sells EV scooters. The name was down significantly today, over 5%, but somebody's bidding on a rebound here. A massive bet by buying the $40 calls, expiration date April 16th, with expectation that the name will climb over 10.5% by then. They paid about $3.70 a piece to enter this trade, bringing the total to about $4 million. And what about this trade for the ticker TWTR? This is for Twitter. I also talked on Monday that I'm buying Twitter puts, and I covered the chart of Twitter in yesterday's video. And here is somebody making a massive bet against Twitter. So apparently the market is indeed listening to the Maverick of Wall Street, because here we have a bearish bet for Twitter. Buying the 67 puts, expiration date March 19th, expectation that the name is going to decline over 5%. It already declined over 5%, but somebody's bidding on an additional 5% or more. And they paid about $1.65 a piece to enter this trade. That brought the total to about $1.5 million. Lastly, what about this trade for the ticker OPEN? OPEN. This is for Open Door Technologies, and the name was down significantly, about 8% today and an additional 2% or so after hours. But somebody's betting on a rebound here by buying the 35 calls, expiration date April 16th, with expectations that the name will climb over 22%. By then, they paid about $2.10 a piece to enter this trade, bringing the total all the way to about $1.5 million. Moving on to the headlines that shape the day, starting with macro news and continuing on our theme of stagflation. We know that inflation is rising higher. We know that unemployment is not recovering as fast as inflation is rising. And the more money the Federal Reserve and the federal government throw at the problem, the higher inflation goes. Meanwhile, unemployment is not recovering regardless of how much money you throw at the problem, because the current rate of unemployment is dictated by the virus. The majority of the job losses that hasn't been recovered yet are in the hospitality, leisure, and restaurants business. Furthermore, a lot of companies learn from the pandemic lockdowns and the work-at-home environment that they don't need a lot of employees to get the job done. They have learned to do more with less, meaning that throwing more money at the problem is not gonna solve it. Yet the Federal Reserve and the federal government still believe that if we throw more money, trillions more, perhaps that will get the job done. It might, specifically now that the virus is easing and we are making significant progress regarding vaccinations. But the problem is that the more money you throw at the problem, the higher inflation will go. And there is no guarantee we will recover the majority of jobs we have lost, paving the way for stagflation. But the deflation propagandists, these geniuses that you guys listen to over at YouTube, have been spreading propaganda nonstop for months now, and they have been proven to be wrong over and over and over again. Yet you continue to listen to these morons. But anyways, their argument is, well, GDP is rising higher and we don't have recession in economic activities. They're actually surging higher, meaning that eventually inflation will be under control because the deflationary pressures will kick into high gear. Yesterday, I exposed to you that the GDP is actually low, paving the way for stagflation, but it is artificially being propped up due to the massive rounds of stimulus. Once the stimulus wears off, GDP will dive down again while inflation will remain higher. Because it takes longer to push down commodity prices once the inflationary spell has taken over the market. Meanwhile, the economic activities that are fueling the GDP higher will run its cycle. So you now know the GDP is being artificially propped up by the stimulus. What about recession in most economic activities? We had a massive ISM number on Monday for the manufacturing ISM, and now everybody's saying, wait a minute, perhaps yields are rising for the good reasons. We don't have inflation or stagflation or any of that. We're having good inflation. We're back in business, baby. The demand is high due to all the stimulus and the recovery we're achieving, and the supply is starting to kick back up according to the latest manufacturing ISM survey. Here is how I poke this argument. Today in the morning, we received the ISM Services survey, and here it is.
Yes, and all the numbers actually have been improving versus expectations, but not on this one. On ISM services for February, we're moving the wrong way. Expecting a number close to 59, 55.3, 55.3 sequentially, following 58.7, the January read, and 55.3 is the softest read going back to May when it was 45.4. So this definitely isn't a high water mark post-COVID, and it's the service sector, which makes it that much more important to monitor. And of course, we all know services are the part of the economy we're missing, and hopefully will come back most aggressively.
A massive bomb. A massive miss. So how could anyone say that the rise in yields is actually due to quote-unquote the good reasons when you have a massive miss in the most important sector of our economy, the services sector? And furthermore, how could you say the yields are rising for the quote-unquote good reasons when unemployment is closer to 10%? According to the Federal Reserve Chairman himself. Pull your head out of your ass. Furthermore, was the manufacturing number from Monday even accurate? Or are we just seeing a rise of inflation? The economic activities are not picking up at all. Here is CNBC talking about the ADP report that we received in the morning. It came out disappointing, by the way, furthermore solidifying the argument for stagflation. But let's see if you're going to catch what I want you to catch. Take a listen and pay attention, and let's see if you're going to catch it or not.
Welcome back to Squawk Box. ADP, the private payroll company, forecasting that private payrolls rose by 117,000 in February. That's quite a miss relative to the forecast out there for ADP and the jobs number on Friday. They revised up their January payrolls to 195,000 from 174,000. Now, looking at some of the details here, 225 was forecast on the estimate for economists. So 117 suggests maybe there should be some downward revision to the February number. Goods sector down 14,000, services sector up 131,000, but all of that much less than what's needed to bring back employment to the level where it was in February before the pandemic began. The non-farm payroll estimate for Friday, 210,000. That includes private and government employment. Looking at it by business size, pretty even across the board. Small business up 32, medium up 57, large businesses gaining by 28,000. And then by industry, the leaders, trade, transport, and utilities up 48,000, education and health services up 35, leisure hospitality up 26,000, but they have a very long way to go to get back what was needed. Construction and manufacturing lagging there. The manufacturing number kind of interesting because the ISM number is showing employment doing well there. Andrew, by my count, we're still down 9.8 million jobs compared to February. The bulk of that in the service sector, 7.6 million, and the bulk of that, leisure hospitality, down 3.8 million. So when you see a gain of 26,000 jobs in a normal month, that would be great. But considering how far we have to go, it's just simply not enough.
And here it is. Did you catch it? The ADP report for private payrolls shows that we actually saw a decline in job creation in the manufacturing sector. Meanwhile, the ISM manufacturing number we received on Monday was the best reading since 2004. So who's lying here? Who is cooking the books? Because you can call me a conspiracy theorist all you want, but I think I've seen enough in my life of cooking the books. How the hell is the ISM Manufacturing Index reading the best reading since 2004 when we actually lost jobs in the manufacturing sector according to the ADP report? Try to solve this one for me and let me know if you get an answer. Back to our stagflation conditions. High inflation, check. Low GDP, not the fake one, check. Higher rate of unemployment, check. Recession in most economic activities, it is mixed, but perhaps when you remove the cooked books, it's actually bad. And what about the poor implementation of government policies? I think both the inflationary and deflationary crowd agree on that one, that the government is inefficient and incompetent. But if you're not convinced, let me give you some more. New ADP jobs report is out. At the jobs growth rate over the past 6 months, it would take over 4 years to get to new all-time highs in job numbers. I repeat, at the jobs growth rate over the past 6 months, it would take over 4 years to get to new all-time highs in job numbers. And this is after all the trillions that was spent already. So you tell me, when inflation is rising so fast and so hot, meanwhile, it would take at least 4 years for us to recover the employment picture, isn't this a prime recipe for stagflation or not? Here is more from the ISM survey. Cost pressures remain elevated, the rate of input cost inflation accelerating to the fastest on record since October 2009. In response, firms raised selling prices at the second quickest rate on record. So the ISM services reading was actually bad, but the input prices went higher anyways. Once again, hello, stagflation. Here is more. The rate of job creation eased to the slowest in the current 8-month sequence of growth. The ISM new orders tumbled 9.9 points to 51.9, but prices surge to 71.8 from 64.2. Orders down, prices higher. Again, what more do you need to be convinced? I'll give you some more. From today's ISM Services survey, quote unquote, suppliers are taking the opportunity to propose price increases that are above and beyond normal expectations, causing significant concern, end quote. And this is with some sectors still to fully open, which suggests we could easily see CPI above 4%. Let me translate this for you. We're already seeing massive inflationary pressure before we even open the door for the reopening phase of this recovery. Can you imagine what will happen when everybody actually starts to stampede and splurge in the economy, flushed with the new stimmy money? Inflation will explode higher, even according to the fake, outdated formula that the Federal Reserve uses. And why is this important, by the way, for us market participants? If inflation is going to get out of hand, the Fed can kick the can down the road all they want, but the inevitable would happen. It's a game of musical chairs. You can extend the music all you want, but the longer you play the music, the less shares you're going to have when the music finally stops. Why is that? Because the Federal Reserve will have to taper their bond purchasing program, and they will have to increase rates against their wishes. You're not going to be able to play this game any longer. Here's more regarding inflation, specifically gasoline prices. U.S. weekly gasoline stockpiles fall by the most since 1990. Demand higher, prices higher, supply nowhere to be found. Doesn't take a genius to figure it out. And what is the Federal Reserve doing, by the way, to remedy all of these inflationary fears? More propaganda. Here is Chicago Fed Evans. 2.5% inflation does not worry me. 3% on its way to 4%, on its way to 5, on its way to 6, on its way to 7 could be a problem. Of course, all of these Fed personalities, they've been doing hash for so much, and we're talking about the good hash. This is the Federal Reserve hash, not the one you and me use. This is the good stuff that erases your brain cells altogether. You start making stupid statements every single day. There is more from Evans. Lesson of taper tantrum was be credible on meeting goals, not going to even think about QE taper until see further substantial improvement. Mr. Evans, there isn't going to be any substantial improvement, regardless of how much money you're going to throw at the problem. You're only going to create more and more inflation. It is time for a new approach to figure out how the Federal Reserve and the federal government is going to recover employment. But of course, in reality, the Federal Reserve could give a rat's ass about the unemployed or Main Street because their main mandate is to prop up, preserve, and inflate the assets of the wealthy. The Federal Reserve is a tool created to help the rich, not to recover employment. The Fed has zero power of doing anything regarding employment. And we also heard from Richmond Fed President Barkin. And President Barkin said that the U.S. economy is poised for a very healthy spring and summer. But when President Barkin was asked that perhaps this quote-unquote very healthy spring and summer will actually cause inflation, and inflation will push Treasury yields higher, and therefore perhaps the Federal Reserve will have to cut rates, all of a sudden Mr. Barkin started to bark. And he said the Fed's rate guidance is explicit. Investors should watch outcomes. Of course, Mr. Barkin is barking at the problem instead of addressing it. And rumor has it that Mr. Barkin is a fan of Dogecoin. And here is more propaganda from the Federal Reserve. Today, the Federal Reserve released its quote-unquote beige book. And what they're trying to do right now is they know that all of the cocaine they supplied into the economy is causing the economy to overheat. So things are going great, right? And we should start to taper the bond purchasing program. It is not needed anymore. We should let yields rise higher, as they should during high inflation. Not the Federal Reserve. The Federal Reserve want to play both sides. They want to tell you that the economy is great. Don't panic. Don't worry about anything because the economy is recovering tremendously. It's doing great. But it's not doing too great where you have to worry about inflation. Once again, they want their cake and they want to eat it too. And therefore, in their beige book, and by the way, they call it the beige book, from all the sweat stains from the Federal Reserve, personalities passing the paper back and forth, trying to make shit up. But here it is, the most important take on prices, and here is where the Federal Reserve cannot deny the facts. On balance, non-labor input costs rose moderately over the reporting period, with steel and lumber prices increasing notably. In many districts, the rise in costs was widely attributed to supply chain disruptions and to strong overall demand. Transportation costs continue to increase, in part due to rising fuel costs and capacity constraints. Reports on pricing power were mixed. Some retailers and manufacturers affected by input cost increases reporting the ability to pass prices through, while many others were unable to raise prices. Several districts reported anticipating modest price increases over the next several months. Modest. They continue to use this word over and over again to play the trick, the psychological trick, that yes, prices are getting out of whack, but it is modest. What about employment and wages? Because if inflation is rising higher due to high input prices, how is the employment picture going on? Because if inflation is rising higher, employment is recovering, and wages rising higher, then we have a healthy inflation. But if inflation is rising higher while unemployment hasn't recovered yet and wages are not moving higher, then we are heading for stagflation. So let's hear from the Federal Reserve. Most districts reported that employment levels rose over the reporting period, albeit slowly. Labor demand varied considerably by industry and by skill level, and many contacts noted continued difficulties attracting and retaining qualified workers. You know why? Because when you print money out of thin air and you throw the stimmy money all over the place and people are making money over at Robinhood, they don't need to work anymore. The boys are gambling over at Robinhood and they're scoring big by buying call options. Meanwhile, the girls are making so much money, more than they ever seen in their lives, more than any job can pay, from OnlyFans. Where are you going to find your skilled workers? Labor supply shortages were noted by contacts as most acute among low-skill occupations, skilled trade positions. Once again, I'm sitting on my ass, collecting government checks, and I'm getting paid more than waiting tables or cooking or doing any of that garbage in an actual job. Why the hell do I have to look for a job when I'm getting checks from the government? Constraints on labor supply included those related to COVID-19, child care, and unemployment benefits. Overall, contacts expect modest improvements in employment levels in the near term. Several districts reported modest wage increases for high-demand positions, with many also noting upward pressure on wages to attract and retain employees. You know, they're going to let inflation run so hot until your wages start to go higher. Once your wages start to go higher, God forbid, you get paid more, you're going to have to do something about it. Because your lords over at the big corporations, they don't like to deal with high input prices when it comes to labor. On balance, wage increases for many districts are expected to persist or to pick up somewhat over the next several months. So that is coming. It's just a matter of time. You're going to have all of these tech workers, white-collar workers being in high demand, thus lifting their wages higher. Meanwhile, the other side of the economy, the have-nots, the people working at restaurants, waiting tables, and doing other part-time jobs, they're not going to get off the couch until you cut the unemployment benefits and the government checks. And even if you do that, they go back to work and their wages will lag behind the inflation that is going on, once again leading to the phenomena of stagflation. But hold your horses here about any stimmy optimism, because here it is. Republicans are telling me they plan to force Senate clerks to read the full $1.9 trillion relief bill aloud. Typically, that process is dispensed with, but any single member can object and force a full reading of the bill. That alone could take 10 hours, even before votes begin. You know what? I'm supportive of that. If you're going to pass $1.9 trillion bill, you better know what's in it. And we know the part that these our beloved politicians care about. They could care less about the stimmy money that goes to the people. That is about $400 billion. What they care about is how are they going to stuff some free taxpayer money to their donors inside the bill. They also care about the Smithsonian Museum and Harvard and other satanic organizations scoring free taxpayer cash from the stimulus bill. And what about the BlackRock administration? What are they doing? Well, now they're caving and they're saying, oh, wait a minute here. If we give a lot of cash to people who don't need it, perhaps that money will go into Robinhood accounts and will create another asset bubble that perhaps will pop, and then we're going to have another problem. So here it is. Biden has agreed to narrow eligibility for the $1,400 stimmy payments. Individuals earning over 80 grand now would not qualify for the payments. That is lowered from $100,000, meaning that before, anybody who make under $100,000 will get the $1,400 stimmy checks. Now you have to make less than $80,000 to get your stimmy checks. So now perhaps you could relate with those ultra-wealthy people who are complaining about the wealth tax from Elizabeth Warren, and they're saying, wait a minute, if you're going to tax me for having a net worth over $50 million, then I'm going to have to talk to my accountant and figure out how to lower my net worth to be under $50 million. Well, now the average American bum can do the same. They can talk to their accountants and try to manipulate their income below 80 grand to receive the $1,400 stimmy money. We can feel the ultra-rich, all the suffering and the problems they have to deal with for being too rich. Here's another thing I want you to think about. Everybody's too focused on the beige book and not paying attention to the Senate modification or modifications to the fiscal stimulus bill. Wave bye-bye to the $1.9 trillion. Why is this important? We know that inflationary fears are rising higher. Perhaps the Senate is taking note. And now they're saying, well, wait a minute. Throwing $1.9 trillion bomb into the economy will blow it up because inflation will go out of whack. So let's try and lower that number, perhaps to 1.5, 1.2. So on one hand, that could tamper inflation expectations, and that could be positive for the stock market because yields will retreat, right? Wrong. Or maybe not wrong. I'm asking you because maybe the market will rejoice the yields went lower because the stimmy money is less than we expected. But wouldn't the market be upset that the stimmy money is less than we expected? Aha, you see the problem here? It's a battle between inflation and the stimmy. Once again, the market, just like the Federal Reserve, wants its cake and eat it too. Either you want stimmy, a massive piece of stimmy, or do you want yields to go lower? One or the other. You can't have both in the story. Moving on to sentiment news, but still continuing with the stimmy theme. Planned proportion of stimulus amount in stock market investment if received in 2021. Here's a survey, and they're asking people, are you going to spend your stimmy money on Robinhood buying call options? 40% of those aged between 18 and 24 said yes. 50% of those between 25 and 34 said yes indeed. We're going to put our blindfolds on and go Naruto style buying the dip. Meanwhile, only 37% of those aged 35 to 54 said they would do so. About 16% of those over 55 or older said they will buy the dip in the stock market using the STIMI cash. And this is really interesting. What about the income level? Those who make over $100,000, 43% of those said that they will use the money to buy the dip or rather invest in the stock market. Well, I got bad news for you because Uncle Joe lowered the threshold of eligibility to 80 grand or less. So there you go. All of these people who make over $100,000 and they wanted to gamble in the stock market, well, now you have to use your own money. No more STIMI cash for you. The good news for the stock market is those making under $25,000, 24% of those said they will spend the money buying in the stock market, while 37% of those making $25,000 to $49,000 said they will use the STIMI money to invest in the stock market. But here was the most interesting finding. What about online investing experience? Those who have less than 12 months or 1 year of experience, meaning those maniacs who joined the market or invaded the market rather since the March bottom, 43% of those people say that if they receive the STIMI money, they will use it to invest in the stock market, or rather to gamble in the stock market. What does that tell you? The STIMI is too excessive. The majority of people receiving it don't actually need it. They will use the money to gamble in the stock market, and the rest will save it to go ahead and splurge in the economy or actually buying the dip once the market finally crashes. Print money out of thin air, you're going to create a freak show, a distortion of asset prices all over the place. Continuing with sentiment news, what about the rocket mania? We saw Rocket rocketing higher yesterday only to come down crashing today. Rocket stock headed back to Earth on Wednesday after shooting up about 71% the day before. Analysts say the company's strong fundamentals are likely already reflected in the stock price. Don't tell that to the maniacs over at Wall Street Bets. And what about the ARK mania? Here it is. Cathie Wood bought $95 million worth of Zoom video as the stock dropped on Tuesday. And guess what? It dropped again today, meaning that Aunt Cathie Wood is gambling in the casino again. Give Cathie Wood your hard-earned cash, and she will blow it up at the bingo table. And of course, it is a cesspool out there. Everybody's out for themselves, everybody's trying to pump, everybody's trying to deceive investors to their own benefits. Among them is snake Kevin O'Leary, who went over at CNBC yesterday and recommended for people to buy Zoom ahead of earnings. And we know what a disaster of a call this was.
Steve, Kevin.
In front of the earnings, Zoom, the absolute standard in what this massive video conferencing has become.
Because the name declined significantly, over 12% now, almost 15% declines in 2 days. Kevin O'Leary did not buy Zoom yesterday. Kevin O'Leary bought Zoom months ago, and he wants to get richer on your dime. And by the way, how bad will this correction be if we continue to see the rise in Treasury yields? Here is from the Dean of Valuations.
Well, big tech may be on the verge of an even bigger problem. Our next guest warns rising rates will spark a 15% correction if earnings do not dramatically exceed expectations. Class is in session now with the Dean of Valuation, Aswath Damodaran, finance professor at NYU. Professor, great to have you with us.
Glad to be back.
15% correction. From what point do you measure that, and what do you mean by higher rates? I mean, is 1.5% higher, or is it really 2%? Is that higher?
Yeah, I'm not a soothsayer, but there are two things that trouble me about this market. One is if you look at the expectations of earnings. Clearly, the market's expecting a strong comeback in the economy, even stronger comeback in earnings. And I don't have a problem with that story. At the same time, the market seems to be pretty sanguine about rates until the last few days. I mean, it seems to assume that the Fed can keep rates at whatever they want them to be. And those two stories, in my view, are at war with each other. You can't have both those stories in your head and expect those stories to both coexist. So what's happened over the last 5 days is something I think we're going to see back and forth for the next few weeks, maybe even the next few months, as the two stories fight for attention. When the rate story wins, stocks are going to go down. If the earnings story wins, stocks are going to go up. But overall, I think there has to be some kind of, you've got to resolve that contradiction. And that's where the 15% comes in. is you build in the expected earnings and you build in a rising rate structure, you're going to come up with a level of the index about 15% below where it is right now.
So the Dean of Valuations believes, according to the math, that when you factor in all of the quote-unquote optimism of corporate earnings and you factor in the rise in yields, the market should go 15% lower. And we know that the Dean of Valuation is kind of dovish, so when he says 15, it's actually probably 20 or more. But of course, will the Robin Hoodiots and the likes listen to the message that the math says regardless of how good corporate earnings are, in the future, bro, the market needs to go at least 15% lower? Of course not, because according to the Robin Hoodiots, stocks only go up and there are no red days. And if there are red days, they are an opportunity to buy. And who is this Dean of Valuations guy? What does he know? We the Robin Hoodiots, are the new Dean of Valuations. Oh, and did you guys catch this? He's back. Breaking. Trump is telling allies he is strongly considering another run for president in 2024. And close advisors want him to choose someone other than former President Mike Pence. Former Vice President Mike Pence for his ticket, according to people familiar with the discussions. And I think I have a clue here on who he will pick to be his next VP. But what really surprised me regarding this news is how come the market did not rally today on the optimism of the revival of market manipulation tweets 2024? Moving on to corporate-specific news, starting with Apple, aka the iMob. And the iMob has been running this monopoly in the so-called Apple Store. They demand that every app operator pay them a cut. If you don't pay the iMob their cut, they will break your knees. But here it is. The Arizona House of Representatives has passed a bill requiring app stores to allow third-party payments. The bill now moves to the state's Senate. Here you go. The iMob forgot to grease a few politicians over in Arizona. What about Google? Of course, we all love and adore Google. We have nothing bad to say about this company, so long as we are using their platform at YouTube. Oh, we love Google. It's so unfair how the government treats them. But Google plans to stop selling ads based on a person's browsing history and will no longer use ad tools that track individuals across websites. Here's a creepy story. I made a video a couple of days ago and I used a thumbnail from the movie The Usual Suspects. All of a sudden, I'm getting video recommendations on my channel to watch interviews and other movies from Benicio del Toro. I have no clue how the algorithms program works, but it is creepy. And what about Ford? You know, we have a chip shortage and it is impacting auto manufacturers negatively, specifically EV makers. Here is from Ford. Ford delays thousands of Mustang Mach-E SUV deliveries. And watch how NIO crashed today. Matter of fact, throughout the week, it has been crashing. But the donkeys continue to buy the dip in NIO and other EV makers. Sweetie, they don't have chips to make them anymore. Stocks go down. EV stocks are short. End of the story. And here's what I said in a tweet today. The shortage of chips is doing a number on auto manufacturers. I expect the value and sales of used cars to surge significantly. Therefore, I'm buying CarMax call options with intention to exercise into stock if my theory plays out. If you're not going to have new cars heading the market due to the chip shortage and other raw material shortage, specifically adding to that the rise in financing rates due to the rise in yields, and it becomes very expensive to buy a new car. But we are still flushed with new stimmy money, so we gotta buy cars somehow, and that will flourish the used car market. The prices of used cars will go higher, but they will still be a lot cheaper, more affordable than newer cars, and more available, to be frank. So that will help CarMax, in my view. And we're talking about CarMax, not Carvana. Carvana is a garbage company. It is treated as a tech company high growth company, and all of their earnings are based on future earnings. So if yields are going to go higher, those future earnings are going to be priced lower, and therefore the stock is going to crash lower and lower and lower. So use your head here and bet on used car stocks that are already established, old school kind of names. And lastly, what about Las Vegas Sands? Well, you might want to call it Macau Sands now, or Asia Sands, because the world's largest casino operator by market value agreed to sell its properties in Las Vegas to Apollo Global Management and Vici Properties for $6.25 billion. Look, this industry is my bread and butter. This is where my expertise for all of these years. I worked in the casino industry in Las Vegas. Business is going to go down and will continue to dwindle over time because Vegas lost its competitive advantage. And the morons running the casinos over Las Vegas have no clue how to run a casino. They're making it less invitable to go and visit Vegas. Parking fees, fill in the blank fees, and by the time you check in, you've already spent your entire budget on fees rather than playing at the tables. So Las Vegas Sands here is saying, wait a minute, we're out of Vegas and we're just going to concentrate on the hottest growth market in Asia, specifically in Macau and China, Singapore, etc. I think it's a good move for the company and it will be good for the stock. There is a reason why I bought the stock yesterday due to technical reasons. I'm not saying that I had inside information regarding the sale, wink wink, but anyhow, it is a cherry on top. Moving on to the heat map analysis, and let's see what's going on here. Once again, the inflationary trade is still outperforming. We're talking about energy. We're talking about financials. Talking about materials. We're talking about certain cyclicals and consumer defensives outperforming significantly, specifically names related to the reopening trade. While the bulk of the losses is where? It's in rate-sensitive sectors of the market. Growth, technology, utilities, certain real estate names declining significantly. Home builders, you want to talk about getting whacked? Lennar down about 4%, D.R. Horton down about 4%, and they will continue to suffer as we see mortgage rates climbing higher. What is outperforming too, by the way? Value names, even within technology. IBM closing about 1.5% in the green, Oracle, Lyft, McAfee closing about 3.5% in the green. If you remember a few days ago, I made a bullish call for McAfee because the valuation is attractive. Even within healthcare, biotech, the high-valued names, the high-multiple names, getting whacked severely. Moderna down 10%, Seagen down over 3%, Royalty Pharma over 7%, and all of these smaller names are getting whacked significantly. What is outperforming in healthcare? Value names such as Merck, Pfizer, United Healthcare, etc. And by the way, while we're at it, let's check on the rotation trade. And we're bringing the rotation trade back again. Here it is. The stay-at-home names, aka the momentum names, suffering severe losses. Meanwhile, the picture is mixed in the reopening names, but we mostly saw gains specifically in the very specific reopening names, such as Planet Fitness closing almost 3% in the green, Cisco almost 2%, Cheesecake Factory, almost 3% in the green. Six Flags, almost 4% gains. American Express, about 2.5%. Chevron, about 1%. So once again, the rotation trade is still alive, months after it started. In my opinion, some of these names in the reopening trade are already way overvalued. And they need a correction of their own. What about the inflationary trade? Mixed picture, but the theme is very clear here. Any financial names outperforming. Any metals, material names such as Alcoa also outperforming. What about the deflationary trade? The picture could not be any clearer. Massive pain across the board, specifically in the high multiple names. And the question is, which theme will remain on top during the upcoming weeks, because everything is becoming overstretched and overextended, including financials and the reflationary names. Moving on to the charts analysis, starting with the SPY 15 minutes chart. We talked about Destination 1 because we saw a head and shoulder formation yesterday. So Destination 1 was closing the gap at 383. We went all the way down there, closed the gap, rebounded slightly higher before reversing lower again. So where is the next destination? In my opinion, it is 300. 76.76, although we could stop at minor support lines along the way. But the picture here is clear. We're shifting towards significant weakness across the indices, not just the Nasdaq. To illustrate that for you, let's move on to the daily chart of the continuous contract of the SPY. We broke a very important support line of 3,862 once again, and now we're just hugging the trend line in yellow. It's just a matter of time here before we crack below the trend line in yellow. And if we do that, we can dance around, but the destination will be ultimately 3,600. We're talking about 10% declines or so from the top for the S&P 500 if we go all the way down to the level of 3,600, which I think is inevitable until or unless the Federal Reserve enacts a policy to curb the rise in yields. Moving on to the Qs, 15 minutes chart. We saw a bear flag formation going on in the Qs yesterday. We said lower prices to come. Destination 1 closing the gap at 317. We went below that and we saw the next destination that I outlaid for you on last night's video, 313 level of support. We saw a massive battle. The Qs did not want to do it. It didn't want to crack below 313. Went back and forth, fighting so hard to hold the 313. But once you crack 313, here comes the floodgates. We're going to flush all the way down. So if you were trading based on the 1 minute to 3 minutes chart, once you saw the confirmation that we broke below 313, the Q's about to give up, fighting for 313, that was your signal to short. You saw a flush down. We will probably see continuation of the flush down all the way to the next destination of 308.5. If that doesn't work, oh boy. Let's zoom out to the daily chart the continuous contract of the Qs. We failed once and for all to recapture the minor trend line in purple, and we have closed below 12,766, which was my support line. Now what? We have 12,408, but in my opinion, that will not be a strong support if we open the floodgates. And tomorrow is going to be a critical date, because all eyes are on Jerome Powell. If Jerome fails once again to control yields from climbing higher, then the floodgates will open and it could take us down all the way to the trend line in yellow. And how big of a correction that would be from the top? Here it is, about 17% or so. The Dean of Valuations says prices should go down about 15% or so. So once again, it is not out of the norm if we go down about 17% or so from the top, revisiting the major trend line in yellow and then bouncing higher. Hopefully, because if we don't, it's going to be a disaster scenario here for the Nasdaq. What about the IWM? Small caps? Now we have a confirmation that the IWM has lower prices to go because it failed once again to recapture the trend line in yellow, which happens to be the lower range of the trading channel. Zooming out to the daily chart to illustrate for you. We have broken the momentum in the RSI. We have an acceleration of negative momentum in the MACD indicator. Now what? The only thing left here to argue for the bullish side in the IWM is we are still in a series of higher lows that is about to be broken too. Once you break the series of higher lows, good night, Irene. What about the Dixie, the dollar index? Once again, the Federal Reserve is manipulating the dollar higher to push commodity prices lower, hoping that would influence yields to trade lower. And if that continues, then perhaps we're seeing a bull flag formation in the dollar index that would take us all the way up to 92. Add to that, we're hearing talks about a reduced stimulus bill that would be positive for the US dollar. And by the way, the climb in the US dollar is not necessarily good for stocks. It might be good for certain names, but for the majority of the market, they'd rather have a lower dollar than a higher one. What about gold? Gold is getting whacked again. No mercy whatsoever for gold, so long as Bitcoin continues to outperform. The challenge here for Bitcoin is to prove itself as a decent hedge against inflation and volatility in the stock market. So far, so good. Bitcoin is holding. It is actually rising today amidst all of the volatility in the Nasdaq and the overall market and all of the inflationary fears. So if Bitcoin works, why do we need gold? At least this is the argument for now. What about the TNX, the 10-year Treasury yield? We saw another bull flag formation breaking higher. We saw a gap higher in yields today. The expectation is higher readings for the TNX. Shifting to the VIX, what do we see here? A massive day higher, recapturing the support of 25. We talked about a positive cup and handle formation that is supposed to take us higher. Now, you might look at the candles and say, well, it doesn't look like a cup and handle for me, so let me help you out. It looks like a cup and handle from a line chart perspective. That should take us higher all the way to at least the levels of 30.5, the next resistance. What about Apple? Apple, we talked about the importance of 125. Once you break 125, you're going to see a lot of pain to come. You failed to keep the 125 as support. And once I saw the attempt to recapture 125 today, and then failing, getting rejected, and trending lower, that was a signal for me to buy Apple puts. You saw Apple flushing down significantly. We have 120 to look for, but the likelihood is, if the negative momentum continues, we will break 120. We have 117 and 113 to look for any support. What about the souffle? The souffle is not doing so hot so. It looks like that my target of 599 is going to be reached because Tesla is the poster boy overvaluations in the market. We were expecting the name to go all the way to retest the trend line in yellow and try and recapture it. That didn't even happen. Tesla's reversing before it does any of that. That in itself is a very negative bearish signal. 599, and then we reassess whether to switch to calls or double down on the puts. What about the RKK? More pain for Cathie Wood. And my target of about 34% correction is looking more and more likely right now because we have a major trend line here. We diverged way higher from the trend line, and the expectation is that you're going to have to go down and re-tag that trend line for support. But I am even more bearish on the RKK. I think we're going to breach that trend support. Why do I say that? Take a look at the big picture from the weekly perspective. We just started to curl down in the MACD indicator, creating red impressions in the histogram. We haven't seen that happening since the crash of last year, meaning that the pain we saw in Cathie Wood land the last few weeks, that is just the appetizer. More pain is about to come. Now let me illustrate something for you. Here is the momentum ETF. Big down day, and we were about to break a very important support level in or around the level of 156.71. Just like the RKK, this is the first time since last year's crash when we are seeing the momentum ETF creating red impressions in the histogram. We saw fake movements before, back in October, November, but that was a minor one, just a retag, small impressions in the histogram, and we bounced higher. This time, it doesn't look like we're going to bounce higher. It looks like we're going down and way down. Let's contrast that with a value ETF. Specifically the VTV. The value ETF is pretty much trading at all-time highs. No pain whatsoever from the last few weeks of rout in the stock market. But is it getting too extended itself? Even the value names are getting too extended, in my opinion. And here is the last illustration for you before we move on. The performance between the momentum ETF in orange versus the VTV, the value ETF in blue, since February. The value ETF is up about 7%. The momentum ETF is down 4.5%. I hope that the message is very clear here. Continue to track the correlation between the momentum ETF and the value ETF. With that being said, we're moving to the conclusion of this video. Very important day tomorrow. Make or break. Will, quote-unquote, our hero save us? Once again, how will he save us? Operation Twist. That is the most viable option for now. The Fed need not to increase their bond purchasing program. They need not to extend the maturities. And yield curve control is too aggressive. So what is the viable option for now? Operation Twist. Shift the buying from the shorter end of the curve to the longer end of the curve. to artificially push yields lower. The question is, will Jerome Powell announce that as a policy, or is he going to start doing that behind the scenes? Either way, how will the market respond? Will the market respond as expected by saying, oh, look at that, yields are going lower, let's buy the dip in technology? Or will the market read through the manipulation and say perhaps that the Federal Reserve is more worried and nervous about inflation than they're letting out to the public, and we will see another panic sell-off? At the end of the day, we know that the Federal Reserve has very little control over the yield curve, specifically the longer end, and the options are limited here. You let the genie out of the bottle, you're not gonna be able to put it back easily. If ever, the genie is just gonna be out there forever. And I will leave you again with the Dean of Valuations.
In line there with that?
I completely agree. I mean, I think, you spend $1 trillion here and $1 trillion there, sooner or later, it starts to add up to real money, as they would say. At some point in time, I mean, we've front-ended a lot of spending that we would have done over 4, 5, 6 years. So I think that, and that's what troubles me about the story. If earnings are coming back because we're feeding money into the system, then how can you stop rates from coming back? The Fed can't stop them if inflation hits 2, keeps going. Because, the Fed can say whatever it wants. But if inflation hits 2.5%, 3% and keeps rising, there's nothing the Fed can do to keep rates from going up. Absolutely nothing. They can try to tweak it at the margin, but the Fed will be more spectator than rate setter at that point in time.